The Federal Reserve has officially cut rates for the first time in 4 years by 50 basis points, or in plain English, 0.5%. What does this mean? When the Federal Reserve cuts rates, they are specifically cutting the federal funds rate, which is the rate that banks use to borrow from one another. The federal funds rate is also connected to the federal prime rate, of which is the consumer rate that is tied to loans such as home equity lines of credit, credit cards, auto loans, and more. So, when the Fed cuts interest rates, it directly impacts the federal prime rate and lowers the interest rates on these type of loans. However, it is important to note that the Fed rate cut is not directly tied to mortgage rates. That said, mortgage rates usually get better leading up to a Fed rate cut as the bond market trades more favorably, thus lowering mortgage rates. This is why, as of today, mortgage rates are almost 2% lower than the peak of this inflationary rate cycle. It is important that we share with consumers that a Fed rate cut by 0.5% does not translate to an exact 0.5% cut to mortgage rates. They are not directly connected. At the end of the day, a cut is an incredible step to increase both buyer and seller activity. The Matt Weaver team is on standby and ready to serve you and your home buyers. Let's continue winning.